Welcome to The Explainer. There's this huge myth that investing is only for the rich, but that's just not true. The stock market is maybe the best wealth-building tool ever made, and guess what? It's for everyone. So today, we're going to break it all down, step by step, and show you exactly how to make your money work for you.
All right, let's just jump right in with a big question for you. Think about it. Is your money working as hard as you do? You put in the hours, you save up, but what's that cash actually doing? Is it out there growing, or is it just, sitting in an account, kind of shrinking every single day?
Okay, so look at it like this. When your money's in a regular old bank account, earning less than 1% interest, it's actually losing value because of inflation. It's like trying to fill a bucket that has a slow leak, but when you invest, you're plugging that leak and attaching a rocket to the bucket instead. You're giving your money a real chance to grow, and I mean really grow.
So you might be asking, okay, how do I actually do that? How do I turn my savings into one of those wealth-building engines? Well, the secret sauce, the magic ingredient, is something called compounding. Let's call it the compounding money machine. Let's see how this thing works.
And the best part about this machine, it's not some secret club with a velvet rope. Nope. It was literally built to create wealth for anyone and everyone who decides to use it. The only thing you need to turn the key and start the engine is, to just get started. It doesn't matter if it's a little or a lot.
Okay, and this is where you really see that machine go to work. Check this out. Let's imagine you invest $2,000 a month for 40 years, and let's say you get an average 8% return, which is historically pretty reasonable. You'd end up with over $6.2 million. But here's the crazy part. The thing that really blows my mind is that of that 6.2 million, more than 5 million of it is pure profit from growth. Your own money was less than $1 million. That right there is the power of compounding.
Now, don't get me wrong, an 8% return is awesome. It's totally achievable and can absolutely make you a millionaire. But what if we could do just a little bit better? What happens if you can squeeze just a little more performance out of your investments? You won't believe the difference it makes.
Okay, this is where things get, kind of bonkers. Look at this comparison. That 8% return gets you to 6.2 million. Fantastic. But if you can bump that up to 12%, just 4 percentage points more, that same exact investment doesn't just go up a little, it explodes to over $18.4 million. Let that sink in. A tiny 4% boost triples your money in the long run. This is exactly why finding the right strategy is so, so important. All right, I know what you're thinking. Those numbers are insane. But how does a normal person, a beginner, get returns like that without basically just gambling everything at the casino, right? Well, the good news is there's a really smart, simple, and low-risk way to do it. Let's get into the strategy. And here it is. It's called the ETF strategy. Now, ETF just stands for Exchange Traded Fund. The easiest way to picture it is like a shopping basket. But instead of groceries, it's filled with tiny pieces of hundreds, sometimes thousands of different companies. And you can buy that whole basket with just one click. It's brilliant because it's super simple and it's low risk because you're not betting on just one company to succeed. You've spread your bet across the whole market.
So why are these ETFs this secret weapon for beginners? Honestly, it all comes down to one thing: fees. On one hand, you've got these old school funds where some manager is trying to be a genius and beat the market. And for that privilege, they charge you really high fees. On the other hand, you have these simple, passive ETFs. They don't try to be heroes. They just aim to match the market's performance. And because of that, their fees are ridiculously low. And here's the kicker. Study after study shows that these cheap, boring ETFs almost always do better than the expensive ones in the long run. And this chart, this right here, is the proof in the pudding. This is the S&P 500, which is basically a scorecard for the 500 biggest companies in America. You can buy an ETF that owns a piece of all of them, and just look at that trend. Yeah, sure, you see the scary dips and drops along the way, but the long-term direction is unmistakable, up and to the right. When you own the whole market, you're not worried about one company. You're just riding this massive, powerful wave of overall economic growth. Okay, so we've got our game plan. Buy a low-cost ETF and own the whole market. Simple. But, to feel truly comfortable, you gotta speak a little of the language. All that investing jargon can sound super intimidating, but trust me, the main ideas are actually really straightforward. So let's quickly break down the 3 big ones you need to know. First up, you'll always hear the words share or stock. They're the same thing. Just think of a company as a giant pizza.
Buying one share means you're buying one slice. That's it. You're now a tiny owner of that pizza company, and you get a tiny piece of the profits every time they sell a pizza.
All right, next up is EPS, which stands for earnings per share. Sticking with our pizza analogy, if your share's one slice, the EPS tells you how much profit your specific slice made. It's just all the company's profit divided by all the slices out there. So a bigger EPS number just means your slice of the pie is getting more profitable. Simple as that.
And the last one, the PE ratio. That stands for price to earnings. This one just tells you how expensive a stock is compared to how much money it's making. So if a stock has a PE of, say, 15, it means you're paying $15 for every $1 of profit the company makes. It's just a super quick way to see if you're getting a good deal or if the stock might be a little overpriced. Okay, we've talked about why you should invest and what to invest in. So now let's get to the most important part, how you actually do it. Let's walk through the simple, actionable steps to get you started, like today. And honestly, the game plan is super simple. Step 1, figure out your goals. What are you even saving for? Retirement? A down payment? Just write it down. Step 2, open a brokerage account. Think of it as a bank account for your investments. You can do it online. It takes maybe 10 minutes. Step 3, pick a low-cost ETF. Like we talked about, something that tracks the S&P 500 is a perfect place to start. And step 4, and this one is the most important of all, invest consistently. Set it up so it happens automatically every month. Don't even think about it. That consistency will beat trying to be a genius and time the market every single day of the week. And all of this really brings us to one final powerful thought. You've probably heard that saying, the best time to plant a tree was 20 years ago, the second best time is today. And that is so, so true for investing. The most important ingredient for building wealth isn't having a ton of money to start with. It's having a ton of time. The earlier you get that compounding machine running, the more work it can do for you. So really, the question isn't, can I afford to start investing? The real question is, can I afford not to?